you think this is just another overseas headline that won't touch your operation, you might want to look at the tanker map. Right now, ships are slowing. Some are anchoring outside the Straits of Hormuz. Traffic isn't normal. There's no official closure, no confirmed disruption. But traders don't wait for confirmation, they price risk. And that's what we're seeing. The question this morning isn't whether Iran shuts anything down, it's how much risk markets will price before anything actually happens. So let's map it out. Crude oil for April is trading at $70.97. That's not exploding higher today, but it's holding elevated levels. That tells you there's premium in the market. If tanker traffic keeps thinning, if insurance costs rise, if even one shipment gets delayed. You don't need a shutdown to see $75 or higher. Energy moves and agriculture eventually fills it. Look at the board. Corn for May is trading at $4.50. Quiet, steady. But if energy stays firm, ethanol margins shift, freight shifts, input expectations shift. Corn doesn't have to react today, but if energy risk sticks around, it will matter. Soybeans for May are trading near $11.65. Beans are more globally sensitive. Shipping costs matter, export math matters. If freight spreads widen, that changes competitiveness. Not dramatically overnight, but gradually. And gradual moves build trends. Oats for May are trading near $3.15, thin market and low liquidity. If volatility spreads across commodities, smaller markets can move fast. Live cattle are trading near $233.65. Feeder cattle near $349.75. Both are higher. That tells you traders aren't pricing a feed cost spike yet. But if crude stays elevated and corn lifts, feeders become the pressure point. Not today, but that's where sensitivity is. Lean hogs are trading near 95.58, slightly lower. Hogs react faster to export swings and margin compression. They're worth watching if global risk sentiment shifts. Weather adds another layer. Parts of the southern plains remain dry. Moisture in the northern plains is uneven. The corn belt is mixed heading into early field work. Nothing extreme, but not perfect either. When you combine moderate dryness with elevated energy risk, uncertainty increases. Markets price uncertainty. Here's the chain reaction to watch. Shipping risks build. Energy volatility expands. Freight costs rise. Fertilizer expectations shift. Producers adjust acreage math. Funds adjust positioning. This doesn't happen in a day, but narratives build. And markets move before headlines confirm anything. It's mag news. Leading maritime insurers are pulling war risk coverage for vessels entering the Persian Gulf, especially near the Straits of Hormuz, one of the world's most critical energy trade routes. This means carriers face much higher premiums or even refusal to enter the region, reducing traffic and increasing costs even before a formal closure. Story number 2, U.S. economic resilience faces a new test. U.S. officials are warning that the Iran conflict adds a fresh layer of economic uncertainty on top of an already fragile global backdrop. Higher oil prices, risk premiums, and supply shaky fundamentals could ripple through the interest rates, inflation expectations, and sector rotation. Story number 3, energy and fertilizer risk looms largest for ag markets. Analysts are flagging that a prolonged Iran-related conflict could threaten fertilizer shipments and oil price stability, which historically move fertilizer cost curves and acreage decisions across crop cycles. This isn't just oil supply, it's fertilizer logistics, and that's where agriculture feels the most pressure outside the cash grain markets. Story number 4, global market volatility already underway. The broader macro narrative is shifting right now. Hostilities between Iran, Israel, and the U.S. are being reflected as a major global economic and commodity risk event, not just a regional geopolitical story. That's causing shifts in investor positioning, safe haven flows, and price discovery dynamics across energy, currencies, and commodities alike. So what would change this story? If tanker traffic normalizes and tensions cool, the premium fades. If shipping disruptions increase and crude pushes towards $75 or $80, That changes the math quickly. Right now we're in the pricing risk phase, not the disruption phase. So let's recap the board. Corn's trading near 450, soybeans near 1165, oats near 315, live cattle near $333.65, feeder cattle near $349.75, lean hogs near 95.58, and crude near 70.97. No explosion, but elevated risk. And sustained risk reshapes margins faster than most expect. This is Boots and Bushels, your daily look at the markets that feed America, markets under pressure. And we're watching a map. Back here again tomorrow.